Okay, let's unpack this. Navigating finances today, it feels tough, doesn't it? Like sailing in a storm sometimes.
It really does.
And rent, well, that's one of the biggest, most unavoidable costs for so many people. But what if, like, the way we actually pay rent is starting to change?
Precisely. We're doing a deep dive today into something that's moving from being a pretty niche idea to something much more visible. Pay rent now, pay later. PRNPL.
PRNPL. Yeah, it sounds like another one of those fintech acronyms, but the material we're digging into suggests it's becoming, well, a bit more significant than that.
Right. We're drawing heavily from an article by Dr. Pooyan Ghamari. He's a Swiss economist and also founder of the Elan platform. The article is called Pay Rent Now, Pay Later, a Strategic Financial Tool.
Okay, so our mission today is to really explore the economic thinking behind this, why it's popping up now, what the strategic angles are.
The advantages, definitely, but also the risks. We need to look at the whole picture.
Yeah, and the wider impact, too.
Yeah.
It's about understanding why this thing, maybe once seen as kind of fringe, is becoming a legitimate option for people dealing with, incomes all over the place, rising rents, credit getting tighter.
Risk pressures converging.
So diving right in, what exactly is PRNPL? Like, fundamentally, how is it different from just paying your landlord the usual way?
Well, at its core, it's about adding flexibility to what's usually a really rigid payment. So instead of you paying the full rent directly to your landlord, say on the first, you use a third-party platform.
A middleman, basically.
Kind of. This platform often pays your landlord the full amount right on time, so the landlord's happy, but you then repay that platform on a different schedule, maybe biweekly or maybe spread over, I don't know, 3 to 6 months. It depends.
Okay, so the landlord gets paid when they expect it. That's key for them, I imagine.
Absolutely.
And the tenant gets a different payment rhythm. I liked how the source material kind of puts this into a bigger economic context.
Yeah, it fits really neatly into this trend people are calling the atomization of credit. Think about it. Credit used to be for huge things, right? Mortgages, cars.
Like big ticket items.
But now, with fintech being embedded everywhere, even a big recurring cost like rent can be broken down. It's like taking that one large payment and allowing it to be microfinanced digitally.
So credit's getting much more granular.
Exactly, and
Okay.
embedded right into everyday transactions.
That makes a lot of sense.
Yeah.
Applying microcredit thinking to maybe the single biggest monthly bill people have.
Yeah.
So given that, why PRMPL? And why now? What's driving this shift?
Well, there are a few big things coming together. A major one is just how work itself is changing. The rise of the gig economy, freelancing.
Contract work. So income isn't that predictable monthly paycheck for everyone anymore?
Exactly. It can be really uneven. Some months are great, others not so much. And a big fixed rent payment due on the first, that can hit really hard in the leaner months.
Yeah, I can see that.
And then you layer on top the general economic climate, right? Inflation eating into what people can buy, interest rates going up, making traditional borrowing more expensive.
Or just harder to get.
Yeah. People's finances are just generally more stretched, more volatile than maybe they were a few years back.
And the material mentioned a generational thing too, didn't it?
It did, yeah. Younger groups, like millennials and Gen Z, often seem to prefer having more liquidity, more flexible payment options. They might prioritize having cash accessible for sudden needs or opportunities rather than being locked into big fixed payments every month.
So PRMPL kind of aligns with that desire for more financial agility.
It does. So you see this dual purpose emerging. For the tenant, it's about optimizing their cash flow, giving them breathing room.
And for the landlord.
Well, for the landlord, having that third-party provider step in means they're guaranteed to get paid. The provider essentially underwrites the tenant's payment for that month.
So it reduces the landlord's risk.
Significantly. That intermediary role is really what makes it potentially work for both sides at the same time.
Okay, let's walk through it then. Say I'm a tenant and I want to use one of these services. What's the actual process? How does it work day to day?
Typically, you'd apply through a specific platform. The article gives examples like Flex or Built, or sometimes these services are built right into the software your landlord or property manager uses.
Okay, so you apply, get approved, then what?
Then the provider basically steps in between you and the landlord for that month's payment.
They pay the rent for you?
Pretty much. They send the full rent amount to the landlord, usually right on the due date. So from the landlord's perspective, nothing really changes. They just get paid.
Okay.
Your obligation then shifts. You no longer owe the landlord directly for that month. You owe the PRNPL provider. and you pay them back based on the schedule you agreed on when you signed up.
Right, which could be, what, bi-weekly payments or maybe paying it all back a bit later or stretching it out over a few months?
Exactly. It depends on the provider's terms, your credit situation, maybe even where you live.
And I'm guessing this isn't free. There have to be costs involved.
No, definitely not free. There are usually fees or interest charges. Could be a flat fee, could be a percentage of the rent.
Okay.
But what's interesting is that the analysis suggests these costs are often lower than the kind of APRs you'd rack up if you just put your whole rent payment on a high-interest credit card.
That's a really important comparison. It sounds a bit like buy now, pay later,
Yeah.
for sofas or electronics. Is that fair?
It's similar structurally, yeah, using a third party to split up or delay a payment, but the article makes a key distinction at the stakes.
Okay.
Rent isn't like buying a new gadget. It's your home. It's essential. So the
Uh,
strategic value of being able to manage that payment to avoid serious disruption if your cash flow gets tight is arguably much higher with PRNPL.
that makes sense. It's not discretionary spending.
Yeah.
Okay, so that distinction is crucial. Let's talk more about the upside then. When does using PRNPL become a genuinely strategic financial move for someone?
Well, one of the biggest advantages highlighted is the liquidity buffer it offers. So if you hit a rough patch with income, maybe you're waiting on a client payment, or you're between jobs, or suddenly you have a big unexpected cost, like a car repair.
Or a medical bill. Yeah.
Exactly. PRNPL can give you that bit of short-term financial breathing room.
Instead of having to drain your emergency fund right away, or worse, miss the rent payment entirely.
Precisely. And used smartly, just for those temporary gaps, it could potentially stop what the research calls financial contagion, where one missed payment triggers late fees, hurts your credit score, and starts a whole downward spiral.
Right, stops a temporary problem from becoming a major crisis. What about this idea that it might actually help your credit score? That feels a bit counterintuitive for deferring a payment.
It can, and this is a really interesting strategic point, credit health optimization. See, unlike just carrying debt on a credit card, which is open-ended, PRNPL payments are usually structured. They have fixed terms, a clear end date.
Okay, so it encourages repayment within a set time.
Yes. And this is the crucial part. In places where these platforms report your payment history to credit bureaus, and that does vary.
Right, it's not universal yet.
No. But if they report, and if you make all your payments on time, it can demonstrate responsible credit behavior. Over time, that could actually help strengthen your credit profile.
Huh. That really changes the perception, doesn't it? From just being a quick fix to potentially being part of a positive financial strategy if you use it right.
Exactly. Another big advantage mentioned is enhanced housing access. This is especially relevant for people who move around a lot.
Like digital nomads or people relocating for jobs.
Yeah, think digital nomads, people on short-term work assignments, expats moving to new countries. They often face mismatches between when they need to pay rent or deposits and when their income arrives.
Right, the timing can be tricky when you're moving.
PRNPL can help bridge those cash flow gaps, making it easier for people to actually move to where the jobs or opportunities are, particularly in those really critical, often expensive markets like, say, Dubai or Berlin or Singapore.
Makes moving smoother for today's workforce.
Right. And we already touched on landlord security, but that's a huge strategic plus for them. Guaranteed rent payment significantly lowers their risk.
Which might make them more willing to rent to people they might otherwise see as slightly higher risk, maybe younger tenants or people without a long rental history in that area.
Potentially, yes, especially in markets with a high tenant turnover like you see in some expat-heavy areas, maybe like in the UAE.
Okay, so it can smooth things out, reduce some friction in the system, offer flexibility. That sounds, well, pretty positive. But nothing's perfect. What are the potential downsides? The risks if PRNPL isn't used strategically, like the article warns.
Yeah, the biggest danger really is falling into a debt spiral. This happens if someone uses PRNPL not just for a temporary cash flow blip, but repeatedly, month after month, maybe because the rent is fundamentally unaffordable for them.
So they keep deferring, and the fees or interest just keep adding up.
Exactly. The debt burden grows, and you can end up in a much worse position than you started, facing delinquency. This risk is especially high in places where maybe consumer protection laws aren't as strong, or where the terms and fees aren't totally transparent.
So it could make a tough situation catastrophic if the underlying income problem isn't solved.
Precisely. It's a tool to manage timing, not a tool to make unaffordable housing suddenly affordable long-term. There's also a risk around over-leveraging without full transparency.
Meaning?
Well, some of these platforms are still quite new, right? They might not face the same level of regulatory scrutiny as traditional banks or lenders.
Ah, okay.
So there's a potential risk of hidden fees, maybe more aggressive collection tactics if you fall behind, or even concerns about how your financial data is being used or protected.
So getting the regulation right is pretty critical for this to scale up safely.
Absolutely. The analysis strongly suggests that regulatory frameworks need to evolve to properly classify PRNPL as a form of credit. That means ensuring clear disclosures, fair treatment for consumers, proper oversight.
And the article mentioned something about the landlord-tenant relationship potentially shifting too.
Yes, this is interesting. It touches on the idea of moral hazard in landlord behavior.
Okay, what does that mean here?
Basically, if a landlord knows they're going to get their rent payment guaranteed by this third party, regardless of the tenant's immediate situation, or maybe even how well they're maintaining the property,
They might become less flexible or slower to fix things.
potentially. It could reduce their incentive to negotiate lease terms fairly or to respond quickly to maintenance requests because their core income stream is secured anyway.
I see. It could subtly shift the power dynamic, maybe not in the tenant's favor.
It could, especially in tight rental markets where tenants already have less bargaining power. It really means tenants need to stay vigilant about their rights and the property condition, even if using PRNPL.
Interesting. Okay, looking more broadly, where is this trend actually taking off fastest? Which parts of the world?
Well, according to the research, it seems to be growing fastest in big global cities that share a few characteristics. Things like having large expat communities, high average rents, maybe economies with seasonal work patterns.
And probably strong tech scenes too.
Exactly. And crucially, strong fintech ecosystems. So think places like Dubai, New York, London, maybe Zurich.
You mentioned Dubai is highlighted in the source material.
It is, yeah. Dr. Ghamari's work specifically points to Dubai as having the potential to become a real global hub for this kind of real estate fintech innovation. The Allen platform he founded is based there, for instance.
And there's a stat about interest there.
Yeah, pretty striking. His analytics apparently showed a 32% jump in interest for rent deferment options just among professionals based in the UAE between 2022 and 2024.
Wow, 32%. That's a big increase in just 2 years. Shows real demand building.
It really does.
What makes some cities sort of more ready for PRNPL than others? Is it just the factors you mentioned?
Those are key, but the research also points to the importance of things like having proactive smart rent regulations in place and also having open financial APIs.
Okay, what do those do?
Well, things like open APIs make it much easier technically for these third-party platforms to securely connect with landlord systems, tenants' bank accounts, and the wider financial infrastructure. It just makes the whole process smoother, more efficient, and potentially more transparent when it's done at scale.
Got it. Infrastructure matters. The article also hinted at some really futuristic possibilities too, didn't it?
Yeah, it briefly speculated about things like tokenizing PRNPL receipts.
Tokenizing, like turning the repayment agreement into some kind of digital asset.
Essentially, yeah. Turning that future stream of rent repayments into a tradable financial instrument. Now, that's probably quite a way off.
Sounds very out there.
It does, but it illustrates just how deeply financialized this whole area could potentially become, how intertwined housing payments could get with complex financial markets.
Fascinating, if a little scary. So, thinking beyond just the tenant and the landlord, who else might see strategic opportunities in PRNPL?
Well, it ripples outwards. Think about real estate developers. If they can offer PRNPL as a payment option when marketing new apartments.
It might attract more tenants, make it easier for people to sign leases.
Exactly. It could potentially boost their conversion rates, get units filled faster, reduce those costly vacancy periods. It removes one big upfront financial barrier for prospective tenants.
Makes sense. Anything to get tenants in the door faster.
Right. And then think about investors, especially those interested in prop tech or fintech.
Oh,
These platforms that offer PRNPL services, they represent a whole new investment category, really. Underwriting rent payments, if done well, could offer relatively stable, predictable monthly returns. It's like a new type of asset class focused on rental income streams.
a different way to invest in the housing market indirectly.
Precisely. And even governments might see a role here instead of, say, direct rent subsidies, which can be expensive and complex.
It could encourage PRNPL.
They could encourage the responsible adoption of PRNPL in high-cost rental markets. It could be seen as a way to help stabilize the housing sector, support residents' cash flow challenges, using private sector tools rather than direct public spending.
Leveraging private innovation for a public policy goal.
Kinda, yeah. It really highlights that core idea from the article about this convergence we're seeing.
Right, this blurring of lines.
Yeah. Housing is becoming less just about the physical building or the service of providing shelter, and much more like an integrated financial operation. The money mechanics are becoming as central as the bricks and mortar.
So wrapping this up then,
Hmm.
PRNPL is clearly a product of our current economic moment, isn't it? Born from those pressures like unpredictable income, rising costs.
Definitely. And it offers some genuine strategic upsides, that cash flow flexibility, maybe even helping your credit if used carefully.
But, and this is a big but from the analysis, it comes with serious risks if you're not disciplined. That debt spiral potential is very real.
Absolutely. And the need for transparency, for strong consumer protection, for sensible regulation, those are critical pieces that need to be in place.
It's fundamentally changing how people manage maybe their biggest monthly bill. And it's creating new dynamics for landlords, investors, maybe even policymakers too.
It's a powerful new tool in the financial toolkit, but like any powerful tool, you need to understand how to use it properly and strategically.
Indeed. And maybe it leaves us, and you listening, with a final thought to chew on as we look ahead. Consider how this trend, this blurring of the line between just having a place to live and these increasingly complex financial products tied to it, how that might continue to evolve. What could that mean for how you access, manage, and even just think about the roof over your head in the future?